Prabhu, if you want to start.
Good afternoon, everyone. I welcome you all for today's webinar. We will take another minute or so to wait for participants to join in and start subsequently. Till then, I request you to stay logged in. Good afternoon to all our participants. I am Prabhudev. I'll be the moderator for today's session. Today's webinar is on the Domestic Resurgence Portfolio. This is a portfolio in the PMS space that was started in the year 2018 with the backdrop of in the backdrop of economic warfare between in terms of trade wars between China and US. This portfolio was aimed at looking inwards within the economy, the growing Indian economy, and subsequently has moved into a more Atmanirbhar Bharat space. Today we have Kuldeep with us, who will take us through this presentation. Kuldeep has joined ASK in 2018 and comes with an experience of more than 19 years. He has worked over 10 years in the sell side for equity research, and core domain expertise has always been in the consumer sector, which includes FMCG and retail. Prior to joining ASK, he was associated with HSBC Securities and Capital Markets India Private Limited. He has worked with Tata Motors for 3 years as well. Kuldeep is an MBA Finance from IIT Bombay and BTech in Electronics and Telecommunication from IIT Roorkee. He is a CFA charter holder as well. Kuldeep, over to you.
Thanks, Prabhu. Thanks for the introduction, and good afternoon, everyone. Thanks for joining in. So it's a quarterly update call on the domestic resurgence portfolio. So as it happens that there are various aspects to any portfolio, and it always starts with the global ecosystem, global indicators, which do influence the portfolio performance. So as we have discussed in past that India had been one of the best performing market, irrespective which time frame we choose. So whether it's a 1 year, 3 year, 5 year, we are among the best performing markets. But every individual economy is having its own drivers. So crude oil prices is having implication that how our physical deficit, current account deficit move, it's having implication for currency and so on. So if we look say crude oil journey in last year or so, it had been roller coaster that last year, almost same time, the crude started boiling up, almost 30% up within a short time frame when Israel-Hamas war did break out. After that, it cooled down and again had risen by, say, another 10 percentage point in recent times. So it had been one of the driver that how the commodity market is behaving. I would say it's still volatile, but relatively benign vis-a-vis say situation 2 years back when the say Russia-Ukraine war started happening. Another driver is the inflation and its implication on the interest rate. So we have seen that the interest rates were rising for almost 2.5 years, and most of the central banks increased the interest rate to its peak number by September 23. And now everybody is hoping that when the reversal will start. Good news is that say one of the major central bank like European Central Bank had a first rate cut of 25 basis point yesterday. That happened after 2019. So it's quite important point. Like right now we are in wait and watch mode that the interest rates have to come down, and it's a more matter of a time. It is bound to happen. And when the interest rate come down, it's a good news for the say growth economy, growth sectors, and growth stocks, particularly where we are positioned. Domestic backdrop, we have seen the event of this week that election results were not in line with the market expectation, and that's the reason there was a knee-jerk reaction on Tuesday. Market in the near term may look for the more clarity, which may come from different aspects like shape of the new government, its priorities, the budget, and so on. Interim, there can be short-term market and the stock-specific movements, which can be accentuated by domestic and the FII flows. Market will be quite watchful for other events like monsoon, which is a key factor in the emerging economy like India. And hopefully the onset of La Nina conditions should boost the rural income. And when it happens, it's going to have a cooling of effect on the inflation part, and which should help some boost, say, rural economy and so on. And people will be also looking for how the interest rate action pan out for other central banks. Geopolitical situation and the developments had been on everybody's watch list for almost 5-6 years in a row. So policy continuity likely to remain at the broad level over the medium term, and India is likely to remain a long-term story. And if we think about the fundamental of the economy and look the GDP growth number, fiscal numbers, Q4 earnings, and so on, the things look quite reasonable and quite attractive if I have to say so. Like GDP growth in FY24 was close to 8.2%, vis-a-vis 7% in FY23. And if we go by, say, RBI forecast for FY25, which happened today, expectation is that FY25 should have again the print of more than 7% GDP growth. Inflation was close to 5% in FY24. This number should come down to close to 4.5% in FY25. And it should provide some room for, say, interest rate cut over a period of time. Corporate earning performance had been strong in FY24, like Nifty earning growth was almost 26%. And for FY25 and 26, we expect double-digit earning growth at the market level. Q4 FY24 earning, like earning growth was close to 11.6%. It was primarily led by the domestic cyclicals, auto, real estate, capex-driven businesses, while BFSI, basically the banking and financial services, continue to have a strong earning performance. At the same time, energy, metals, and IT face the challenges. So overall, Indian corporation performed reasonably well in FY24. In FY25 perspective, the lookout would be that how the geopolitical situation is panning out. There may be some concerns related to relatively lower earning growth vis-a-vis FY24. And another concern people may highlight like the premium valuation to some extent. Despite these challenges, we believe Indian economy is positioned well for coming year. Acceleration in the government capex in the past 2 years can boost private capex, and onset of the La Nina condition can boost the rural farm income, leading to the rural recovery. And if we come to the portfolio, like this particular strategy, so if we analyze how the FY24 had been, so there were certain areas where the performance had been decent, like manufacturing, where the portfolio has close to 17% weight. That particular part of the portfolio delivered almost 58% return. Beverages, where the portfolio weight was close to 10%, delivered almost 70% return. Telecom, again, pretty strong return. At the same time, there were few things which were not working in our favor, like consumer discretionary, chemical, financials. These were the exposures where the performance was not in line with the expectation. And we had the PSU under exposure till November 23, which also had a drag on the overall performance. From the chemical sector overall perspective, inquiry and capex intensity remains elevated level, pointing to a strong structural tailwind, primarily impacted by the short-term adverse cycle due to confluence of various macro factors. If we think about the consumer discretionary, it provides an opportunity to participate in large penetration and premiumization opportunity as growth accelerate. Though there had been some short-term impact due to, say, macro-related issues again. In terms of the financial exposure, it had been a drag for us because there was, say, decent earning growth for portfolio companies, whether it's a banking or NBFCs, but it did not translate into the commensurate stock returns because this earning growth was accompanied by, say, multiple derating. At the same time, we had quite lower allocation for the PSU banks. So under ownership in the PSUs dragged down the overall performance in FY24. Just to make a point, like in FY24, PSU as a pool was almost 10% of the benchmark, though it delivered almost 90% return. So we can say a large part of the, say, benchmark return have come from this particular part of the, say, pool. To address the challenges and take the corrective action, we have done multiple changes in last 6 months. And some of them are over there, like we moved from, say, private banks to, say, PSU bank like SBI. We increased the exposure towards the capital goods, industrial, railways, ports, oil and gas, and so on. So we believe these sectors are continue to have a strong tailwind for many years to come, and earning growth will remain quite resilient over there. That's the reason we have done these changes over there. And it's not about last 6 months. Like if we look the journey of the DRP, like which started in 2018. In 2018, the consumption and financial sector used to be almost more than 80% plus. Over a period of time in 2020, when the COVID happened, then we started making some changes because COVID did bring some opportunity in other areas, like whether it's chemical, manufacturing, industrial, and so on. And over a period of time, this exposure is increasing. So it's not the shift which happened in last 6 months. It's happening at a regular pace, and probably it has picked the pace in last 12 months, if I have to say so. As we speak, say on DRP psychographic, almost 1/3 of the portfolio is having composition coming from manufacturing, defense, capital good, and so on. Consumption is close to 20% of, say, overall portfolio. And while financials is also having the similar number. So basically, we are overweight on infrastructure and engineering, as well as consumption part, while we are having the underweight position on the financial. On the technology and telecom part, basically it's say exposure towards, say, Bharti and say Reliance over there. As I mentioned that we have increased our exposure towards, say, ports, oil and gas. All this is visible. We have reduced our weight towards the chemical sector in last 6 months or so. So this is a snapshot of, say, DRP sector positioning, quite diversified. As I mentioned, when this particular product was launched, as Prabhu mentioned, that at that time, the theme was more inward-looking focus, like trade was the talk of the day. And that's the reason this particular product is focused on more about India. And at that time, it was more focused about consumption and financials. Over a period of time, when the policy changes did happen, many reforms did happen, we started getting allocation towards other area as well. And that's the reason today it's quite diversified, say, strategy, having exposure to various facets of the Indian economy. In terms of say large cap, mid cap, small cap exposure, say it's a flexi cap, almost 55% is large cap, balance is split between say mid cap and a small cap. Earning growth had been quite resilient for this particular strategy, like in FY23, up to FY23 for 5 years, almost 22% CAGR for earning, vis-a-vis Nifty delivery had been close to 16%. In FY12, in FY24, if we look overall number, it was again close to 20% earning growth. In Q4 also, the DRP had almost 17% earning growth, vis-a-vis a benchmark delivering close to 11%. We expect 20% plus operating growth for both FY25 and FY26. From psychographic perspective, like earning growth is quite strong. Return on capital employed, it is quite decent, like almost 30% plus. And these are the factors which we look at, like capital efficiency as well as a combination of strong earning growth had been the key area where we look for the portfolio companies. So if we look the valuation perspective, valuation have become quite reasonable in last say year or so. As I mentioned, that earning growth had been a constant factor for the strategy, and there had been times that say earning growth is coming, but the commensurate return was not there. So today, as we speak, the valuation are quite attractive. So theoretically, a decent part of the earning growth should convert into the stock return. From the overall, say, portfolio performance perspective, May was good and last 3 months were also reasonable. Like in May, the portfolio delivered almost 3.8% return, vis-a-vis say benchmark delivering 0.8%. From 3 months perspective also, say portfolio delivered close to 9.7% return, vis-a-vis say BSE 500 5%. As we discussed in past that in FY23, we had some challenge related to say positioning, like growth positioning, and similar situation in FY24 because of say under allocation towards the PSU. We have taken the corrective action, and results of the same are already visible to some extent. I will stop over here and will be happy to have any question which you might be having.
Thanks, Kuldeep. Thanks for the conclusive data points. Ladies and gentlemen, we will now open the session for Q&A. I request you all to put your questions in the chat box so that we can curate and present them to Kuldeep, who will address them. Kuldeep, in the meantime, we have some questions that have been collated in advance. Given the context of economic growth, India has pegged an 8.2% GDP at the end of March. This is the ninth or 10th time that India has crossed 8% GDP mark. And the interesting part is that out of those 8, 9, 10 incidences, 4 incidences have come in the last decade or so. So in that context, how is DRP, the Domestic Resurgence Portfolio, and the theme positioned in the current environment?
Sure. So as I mentioned during the course of the presentation, that when the economy is growing, it's having implication for both consumption as well as say other areas, like how the economy can grow. It's having various components, whether it's coming through manufacturing, coming through say consumption side. So if we look last couple of years, consumption, there were some slowdown, whether it's a discretionary, whether it's a staple side, because there were macro related challenges like say food bill was higher, food inflation was higher, having implication for the overall inflation and so on. At the same time that there was counterweight available, there is part of the economy which is doing reasonably well, or I would say doing quite well, and that is manufacturing, defense, capital goods, and so on. Because there is strong focus that we have to have self-reliance, we have to have, say, import substitution wherever possible, and we should try our level best to increase the export part. And because of the government policies and multiple reforms being done over a period of time, this is the area which is thriving. So, as I mentioned, that we are making a lot of changes and increasing the exposure towards that particular area. And this is something we have done in FY24. As we speak, almost a third of the portfolio is aligned to the area where a lot of action is happening. So whether it's a manufacturing, whether defense, capital goods, and so on. At the same time, there will be the other facets like whether the technology, telecom, they should also do quite well. If infra is doing well, local logistic is improving, the port should do well. And then there are the sector like oil and gas, like which are always cheap, but at the same time, they did not get the due credit because there were always doubt about, say, the intentions, like how the price behavior would be having for end retail prices and so on. But if we think about this sector, like it's moving toward this generation of a lot of cash flow, which should be deployed for the growth of this particular sector. So the credit was due. What probably they get in say last year or so, and probably it should continue to happen for years to come. So we have tried to align the DRP with the themes, with the areas where a lot of action will be happening in next 5 years or so. And this is how we have done the changes.
Thanks, Kuldeep. The next question is in the context of the last 5 years, or rather the inception of domestic resurgence. So while this was envisaged in 2018, the inward-looking economic focus within the country has picked up post the pandemic. So in the context of a pre and post pandemic scenario, how has this portfolio what has been the journey of this portfolio in the pre and post COVID period?
So I try to address this part during the course of the presentation that when DRP started, it was in alignment with our say philosophy that compounding growth story, and the pre-COVID arena was more about say consumption and financial, like whether say direct beneficiary of the consumption or facilitator of that say consumption. Like when we think about NBFCs, so many companies do facilitate the consumption part of it. So that was the focus. And when the COVID happened, it was boon in disguise because there were many say areas which were earlier more episodic, whether it's a chemical, more or manufacturing, industrial, and so on. They started having a long-term visibility because the world was changing, and that is how we started making the change. Say almost 4 years back, and it's a journey which is on its course and has picked the pace in last 1 year. As I mentioned, that many areas where the policy matters, reforms matters, government say focus matters, those areas have benefited and should continue to benefit because the agenda is growth. And as long as this agenda prevail, this particular strategy is having quite decent exposure in the emerging areas or growing areas, if I have to say so. So from almost nil in the pre-COVID scenario, today infrastructure and engineering would be almost say 27-28%, and it is growing. And other areas of say overall broader economy has also find the place in the portfolio.
Thanks, Kuldeep. Participants, I request you to put in your question and answers so that we can take them up with Kuldeep. The next question, Kuldeep, is in terms of the most recent event that everybody is talking about. The election results came out this week on Tuesday. in the context of the reaction in the market, how has DRP portfolio weathered in this short span, and how are we adjusting to the political landscape that is expected to be rolled out in the coming few months?
Sure. So if we think about the election outcome, probably it was below expectation vis-a-vis, say, general expectation. So everybody was hoping the current expansion will be having quite a strong number, and probably it did not pan out that way. And that's the reason a knee-jerk reaction happened on Tuesday. After that, again, more developments, more news flow, like what could be the course of action for the future government, who will be representing the same. So as and when the picture is emerging, like Mr. Modi has been elected for the representative of, say, NDA, nerves are getting settled. And the way we think about it, more clarity will emerge next week, like regarding who is getting which ministry, and probably say next month or so when the budget is coming. So as and when the more clarity more predictability come, to the extent we get it, like the policy continuity is there, growth agenda is in place. So from, say, positioning perspective, the positioning remain the same, what it used to be, say, pre-election result and the post-election. And after, say knee-jerk reaction on Tuesday, the things are coming back. And this is something we are looking forward to. Like if the reforms, if the policy continuity is in place, DRP is well positioned.
Thanks, Kuldeep. In terms of a couple of years now, last couple of years, where markets have seen exponential run up in the mid and small cap space, in terms of the portfolio valuations, how are we expecting the capitalization space to play out, and how is the portfolio valuation looking like in the coming year or 2 years?
Yeah. So from valuation perspective, I would say at the broader market level, the valuation are quite reasonable, in a sense that it is accompanied by quite a strong earning growth, which happened in last 5 years, right from FY 19 till about 24, almost 20% CAGR at the market level. So whatever the market returns we have seen, it is led by, say, strong fundamentals on the ground. And we hope the earning growth should continue, both for, say, market as well as for the portfolio. And that's the reason, as long as fundamentals intact, earning growth is coming, stocks or the portfolios have to deliver. So because if we look the longer time frame, like our own history of almost 30 years, there is one-on-one, say, movement which happen, like on the longer duration, does stock performance or, say, portfolio performance only responds to the fundamentals, which is the earning growth. So we are confident about, say, next couple of years at the market level, that earning growth should be, say, 13-14% CAGR. And if we think about our own portfolios, it should be quite strong. Like operating profit growth should be more than 20%, and earning growth should, PAT growth should be almost say 18-20% level. Valuation have become reasonable for the portfolio because we have increased our exposure towards, say, some of the PSU names which are more value oriented and so on. So this combination of strong earning growth with the relatively reasonable valuation should deliver decent result for years to come.
Thanks, Kuldeep. So next question, Kuldeep, is on the lines of the performance trends that you mentioned. In the last 4 or 5 years, the portfolio has delivered close to a benchmark kind of a return. In the last 1 year or so, 1 to 2 years, the portfolio has been performing in a nearby range to the benchmark. What are the key changes that have been done in this period, where we have aligned in terms of the stocks and the sector specific allocations within the domestic research portfolio?
The changes part I have already mentioned, like in last 3 months itself, we have made almost 7, 8 changes, whether it's Indian Oil, BHEL, SBI, Gravita, Titagarh Wagon, Adani Ports. Most of those names are representative where the action is happening, like whether it's manufacturing, whether it's industrial, railways, port, and so on. And we have exited from, say, traditional positioning like of private banks and, say, couple of consumer names and so on. We have done some changes from the valuation perspective as well, like JSW Infra delivered quite a strong, say, performance since, say, inclusion about 8, 9 months back. So we have replaced the JSW Infra with the Adani Board, similar space, almost similar earning growth, but relatively lower valuation for Adani Board. So these are the changes which are being done in last 3, 4 months. And actually, this particular, say, cycle started, say, long back, almost you can say in December 23 itself, when we incorporated something like Bharat Dynamics, REC, and so on. So we are making constant changes in the portfolio and making it more aligned and in the areas where the growth is happening and should continue to happen.
Thanks, Kuldeep. A more stock-specific question has come about the company allocation in Gravita India Limited.
Yeah.
This is a recent allocation that we've done.
Yeah.
Can you throw some light on the allocation?
So Gravita India is actually representative of circular economy. Like if we think about the world, there is a strong focus toward the ESG goal that may be coming out of the policy of say different countries. It may be individual company specific policy and so on. And then there are certain areas where it's quite visible, like whether it's a lead or say some other areas in the commodities where say post recycling the product is quite similar to the pre say recycling level. So this is the area where a lot of action is happening at the global level. Say this market is valued at USD 55 billion and is likely to grow at close to 5% at global level. When we think about India, the growth will be sharper, and within the organized space, the number will be even much higher. So we expect at the industry level, in the India, in the organized recycling, there is opportunity to grow at 20% plus CAGR. If we think about, say, Gravita, this company is doing quite well as far as the lead is being concerned. And there are the other commodities where they have ventured over a period of time, yielding the good result. And this area is emerging, and probably many commodities will keep on getting added over there because there is a strong focus on the environment by most of the government. And this is, say, global major in a sense. It's having presence in India as well as in the rest of the world. So if we put all the factors together, we will like to believe the earning growth can be, say, 25-30% CAGR for at least medium to, say, long term. In that context, the valuation had been quite reasonable. So it had been a recent addition, which we have done about 2 months back or so. So from, say, overall tailwind perspective, this circular economic ecosystem is going to have a long journey ahead. And as there will be increased focus on, say, environment and other ESG goals, etc., this area will thrive, and probably this is among the leading company in this particular area, which should benefit out of these tailwinds. So from earning growth perspective, as I already mentioned, we expect quite robust earnings in time to come.
So would we look at higher allocation in this particular stock, Kuldeep?
We are already doing that part. So we started with a say a decent weight, and we are building.
Okay, thanks, Kuldeep. So participants, once again, please keep the questions coming in. We can address stock and sector specific questions from Kuldeep. So Kuldeep, follow up on sector specific aspect. So last few days there was a sudden reaction on FMCG stocks and the consumption side. In line with what you mentioned about the knee-jerk reaction, any thoughts on the space to be captured in the portfolio? Are we looking at adding any FMCG stocks going forward?
So I already mentioned that we have a strong overweight position in the consumer domain as well. Like almost 20% of the portfolio is in that area, and there are a couple of stock like Varun Beverages, Radico Khaitan, which have delivered strong earning growth over a long period of time and should continue to deliver even for years to come. So as I mentioned during the presentation that they represent the beverages part, almost 10% of the portfolio, and delivered almost say 70% return in about 24. And we expect the earning growth in these two companies can be 25% plus CAGR for at least 2-3 years. And so if the consumption is picking up, these companies should also benefit. So we have a decent exposure towards the consumption as well.
Thanks, Kuldeep. So Kuldeep, follow-up question on performance has come in the sense, how has DRP done in the worst situations in the last 3-4 years in terms of the drawdowns versus the broader markets and the benchmarks?
So DRP had almost 6-year journey. It started in June 2018. And the strategy has seen it all. Like in last 6 years, there had been many events of different proportion. Like the genesis of the product was the trade wars. And so June 2018, this product came. In September 2018, there were concerns related to ILFS. 2019, we had the concerns related to, say, national election. 2020, COVID-1 happened, then COVID-2 happened in 2021. In 2022, we had Russia-Ukraine. Last year, again, we had, say, Israel-Hamas war. Interim, the interest rates were rising. So a lot have happened, and the source of the problem may be local, source of the problem may be global. Quantum may also vary. And it has weathered it all. And as I mentioned during the course of the presentation, that we have done the course correction as and when the required changes were required, we have done it. So there may be a period when the things are not working for us. We do necessary change and things do come back. Just to highlight a couple of points, like in FY20, basically the year when the COVID happened, the overall market was down almost 26% plus. DRP was down 16%. And please note that if, say, money is being given to us, it's almost 99 to 100% deployed at any given point of time because we don't take the cash flow. So if everything is deployed in equity, it should be seen in that context. So when the bigger drawdowns were happening at the broader market level, there was some resilience, there was a flow. And this had been the character coming out from the portfolio construct that we try to have a decent defense for the overall strategy and try to remain prepared for any unforeseen event. And that's the reason when the things are not working at overall market level, especially when the volatility increase from say global situation or domestic situation, the things had been relatively better for the DRP. As I mentioned, about 20 years so. And whenever the things are working well, we do the changes and come back. So till CY21, if we look 3 calendar year, DRP was doing better than say benchmark, almost 1.5% CAGR outperformance. CY22 was relatively challenging year when PSUs were doing good and the growth as a pool was not delivering. CY23, we did make a comeback. In January, February this year, the things were not working for us, and we have done again the changes at the portfolio level. As I mentioned, whether it's the last 1 month, 2 months, 3 months, the things have started coming back. So in short term, there can be some disruption of different proportion, which can have some implication for the performance. But we do take the corrective action and respond to the situation so that the overall returns are quite decent.
Thanks, Kuldeep. A question regarding the overall portfolio has come in. An anonymous attendee has asked, what is the difference between ASK DRP and ASK India Vision Strategy? Both of these portfolios are managed by you. And subsequently, a follow-up question is that which one is a suggested option that we can choose as an investor?
So if you think about India Vision portfolio, it was more about value migration theme. Like irrespective whether the source of growth is coming from, say, India or rest of the world, we were venturing into that particular area. DRP had this particular constant, till 2021, almost or 2022, that we could not take the export-oriented name. And that is something which had implication on the portfolio performance from April 20 till September 20, when the export-led themes were doing well. So we took some exception at the strategy level. Now, 25% of the portfolio can come from the export-led name if required. It's a more enabling, say clause being introduced rather than say we have to be like that. So I would like to say that DRP is primarily about India story, playing the different facets of say India growth story. As far as India vision is being concerned, it's having both the components, like whether it's a domestic or say international. So both the strategies having its own say construct own catalyst, and I will like to believe both should deliver a strong earning growth for years to come. There can be say periods entering where a particular theme get attraction, whether it's a domestic or an export, but the way the portfolio is positioned, both the strategies should deliver strong earning growth for years to come, and we should translate into decent stock return in at the portfolio level.
Thanks, Kuldeep. Participants requested once again keep typing your questions in the Q&A section so that we can address them in the webinar. Kuldeep, in the context of the recent events that are lined up, so question has come regarding the interest rate related meeting of the MPC that was concluded today.
Yeah.
In that line, I would like you to address what are the key events that need to be watched out for, or what are the key events that would be essential in the near term in terms of the market direction and subsequently the portfolios trends.
So there are 3-4 things. Like if you think about say global macro perspective, obviously the inflation and interest rate, which everybody will watch out for, like how the central banks are responding to emerging data. As I mentioned in the beginning of the presentation itself, like say European Central Bank had first interest rate cut yesterday, and it's the beginning, the way I think about it. And the rest of the central banks have to follow sooner or later. It's getting rated, but it's bound to happen. So interest rate should come down. And if we think about, say, our own RBI perspective, they have maintained the interest rate today. In terms of the journey ahead, they have maintained that the growth is going to be quite strong, almost 7% plus. Inflation is going to moderate from 5% to 4.5%. So as and when there is more comfort coming on the inflation front, interest rate will be coming down in India as well. So it has to start at some point of time, but it is going to be the global phenomenon that most of the central banks would be cutting the interest rate. And whenever the interest rate do come down, it's a good news for the equity as an asset class, and even better news for growth as a style. Like if we think about ASK, our positioning had been, say, quality and growth. Earning growth had been there, but what market look for, like if the interest rate are rising, the growth style do suffer. When the reversal happen, this particular style should benefit. So from economy perspective, positioning perspective, the interest rate cut is one of the major say development which everybody will be watching for. Second part, I mentioned that how the monsoon is panning out this year. The expectation is that the monsoon should be normal, and if the monsoon is normal, which is a good news for, say, farm income, which is good news for the rural economy. So it will address many questions automatically. So whether it's a situation related to inflation or it's a situation related to interest rate in India, it will get autocorrect. So we are looking forward that the normal monsoon having implication for strong produce and strong farm income. This is something we will be looking forward for. And third thing, like the post-election outcome, obviously the people will be looking that how the cabinet expansion is happening, what's going to happen in budget and so on, what is the priority. And these are the things which are more near-term focus, which all of us would be observing.
Thanks, Kuldeep. Another question has come in the chat box is that how will we show DRP and IVP returns beat or near to benchmark returns? I'm sorry, so I'm not able to maybe get that question, but I think performance aspects you have addressed.
Yeah.
And I think in terms, I'll wait for that question to be rephrased. Next question has come on the recent PSU additions that have been added recently in terms of the portfolio allocations. What are your thoughts on the same?
So like Bharat Dynamics, we added in December 2023. The stock had almost 100% run up in last 6 months. So we have taken some profit off the table and redeployed the similar, say, number in other areas of, again, manufacturing, engineering, infra, because that is the area where a lot of growth is happening. So that is about, say, Bharat Dynamics. And then, as I mentioned, in March 24, or say a couple of months back, we had this shift from, say, private banks to PSU bank, like moving towards SBI, because the earning growth perspective, the number is likely to be quite reasonable, like 15-20% growth is expected over there. At the same time, the valuation are relatively quite cheap. So a well-weather in that particular area. So that is another name. Third is like REC, like again, we added that name about 6 months back. So today, if we think about power, electricity, thermal, it's not a discretionary, say, area of capex. It's more the requirement of today, and it's a global situation that everybody is looking for energy, because the way the, say, whether it's AI, whether the cloud computing, or say upgradation of the lifestyle, the energy requirement are increasing and continue to increase. So either we have a direct play over there, or they can be indirect play like RSA. So if we think about RSA, their loan book should grow at a quite a faster clip, and the valuation had been quite reasonable when we did the addition. So they may be the direct say exposure towards those areas where the growth is quite visible, or can be the indirect beneficiary. So if we think about PSU, SBI and REC among the BFSI space. If we think about defense, as I already mentioned, Bharat Dynamics was added about 6 months back. I also mentioned about say oil and gas space not getting due credit for a long period of time. Valuation had been cheap, is still cheap, and if policy continuity is there, and these companies are generating a lot of cash flow, then these cash flows should be appreciated sooner or later. So that's the reason Indian Oil is being incorporated in this particular strategy. So these are the 4 5 names which we have incorporated, which are having merits for different reasons. Like defense, we believe is not a 1 year, 2 year say theme. It's going to have multi-year say allocation happening through the government side, and same is going to be the case for whether it's a power financing and so on. So those are the exposures we have taken in last 6 months.
Thanks, Sandeep. Next question is on the lines of the stock prices. Question is coming regarding Apollo, APL Apollo, and Titan, who have run their course, and also would like you to address the exit on Relaxo in the past, even though there have been good returns and high valuations.
So Relaxo, we exited long back. It's more about the valuation at that particular point of time, and it was more of a valuation call being taken long back. As far as Titan is being concerned, Titan has delivered a strong return in about 24, like almost 52% up, vis-a-vis say Nifty would have been up almost 29% or so. In Q4 results, there was some disappointment on the margin front, like earning growth was relatively lower than expectation, while say top line growth was quite strong, like almost the 17% growth at the company level and close to 19% in the jewelry sector, which is a key for this company. Like almost 88% of the company's revenue come from the jewelry sector. So what's happening in that particular segment, both from revenue and the margin perspective, are key for this company. So revenue growth was quite strong, like close to 19% growth, but the margin was relatively lower. 2 reasons, like gold prices have risen quite sharply. When it happened, then obviously it's having some implication for the competitive intensity, like how the company will respond, whether in form of the increased discount and so on. But we believe it's more short term. And during its a recent analyst meet, the Titan lowered the guidance of the margin by 50 basis points. Earlier, they used to guide that the margin in the jewelry segment will be more 12 to 13%. Now they are guiding more 11.5 to 12.5%. So 50 basis point cut, which happened. And obviously, it's a front loaded over a period of time, they should recover. So whenever some disappointment happen on earning growth side, there is always a stock reaction. And that is something which happened to the Titan from 3,800 level to almost 3,200 or so. But if you think about franchisee perspective, probably this is one of the most solid franchisee in the consumer space. So what we do, like if we have to take some money off, generally it's more about trimming the exposure. And especially Titan came in the DRP below 1,000 level almost 6 years back. So over a period of time, it had been almost 3 to 4 bagger. And we take some money as and when we get some other opportunity where the risk return equation look more favorable. But in isolation, we believe whatever is happening, it's more short term, like this earning growth should pick up. And from a 2 year perspective, we will like to believe the company should again deliver say 18 to 20% earning CAGR. So there can be some issue for a quarter or two, but if we think about say 2 year, 3 year, 5 year, the earning growth should be quite reasonable for Titan. Second, you mentioned about the APL Apollo. APL Apollo again, for different reasons, there was some disappointment on the margin front. And if we think about say capacity expansion this company is doing and the volume growth expectation, EBITDA growth expectation, we believe this company can deliver 30% plus earning growth for a couple of years at least on the FY24 base. So every business is having its own plus minus, and those things do pan out in the short term. It's all about taking a call whether whatever is happening at the current juncture is going to have a lasting impact or not. The way we think about whether it's APL Apollo or whether it's Titan, there had been some shortfall on the margin front. But if you think about, say, couple of year perspective, both the companies are likely to deliver pretty strong earning growth. And that's the reason they have the place in the portfolio.
So a follow-up question from the same participant, Kuldeep, is in comparison to the exit of Relaxo on valuation terms, does not the criteria apply to APL Apollo and Titan?
So that's a part I'm saying. Like in case of Relaxo, if you look the growth, earning growth had not come for last couple of years. So that is where the distinction comes. Like ultimately, stock returns do follow the earning growth. If the earning growth is a missing quotient, then or missing factor, then we have to take the course correction. Like we have to take the hard call. If it's only temporary issue, the way I mentioned about say APL Apollo or Titan, we have to be a bit more patient, and if required, some trimming may be okay solution. What probably we have done in both the names, and because it's more of a issue of a quarter or two rather than having some say long-term implication.
Noted, Kuldeep. Next question from Akhilesh B is on the Airtel partly paid shares. Question is that why have we held Airtel partly paid shares when we already have fully paid ones?
So it's more about the confidence in the fully paid share. The way I think about it, like in absolute terms, if the movement is similar, like if the 100 books are moving in both partly paid as well as say ordinary share, in terms of the percentage rise, it will be higher in the partly paid. Reason is like fully paid is close to 1400, partly paid is close to 1000, and going forward, the absolute movement in both the shares should be largely like to like. That's the reason I'm saying if I'm confident about say ordinary share, then it makes most of sense that we have the partly paid share as well, because the percentage outcome will be relatively higher in the partly paid share.
So Kuldeep, in that sense, so would we continue to hold the partly paid shares till the consistency is maintained?
So I mentioned like if you look the journey of the partly paid share and take the example of say current base itself, say partly paid is close to 100, close to 1000, while the fully paid is close to 1400 rupees. I'm saying if suppose 100 rupees price movement is there, and it will be more like to like. Okay, so 100 rupees in with the denominator of 1000 translate into the 10% return. 100 rupees with the denominator of 1400 translate into the 7% return. So it's more like an option being taken on the underlying fully paid share, and it enhances the overall exposure towards the telecom sector. So as long as we are confident about say overall fortunes of the telecom sector, and particularly the companies which we are holding like Bharti and Reliance, we try to maximize those particular gains.
Thanks, Kuldeep. Participants, please send in your questions, type it in the Q&As box so that we can take them up. We have a question again on Gravita. So, Mr. Akhilesh, we actually covered the thesis on Gravita in the initial part of the call, and the detailed discussion was done on the same. You may revisit the recording and you will get the details after this call. So, Kuldeep, these were the questions that have come in. Any concluding remarks to take it forward?
So I would say like we have done many changes in 6 to 9 months and tried to align it with the growth areas which are coming from different part of the economy. And those changes have responded. And as and when further changes would be required, we will do it. As long as, say, growth for the economy is being concerned, we remain quite optimistic about it. Growth for, say, overall India incorporation is being concerned, we remain quite confident that there should be decent double-digit earning growth happening. And more so for our own portfolios, we will like to believe that we have delivered strong earning growth in past, and this strong earning growth momentum should continue for years to come. Valuation are reasonable from the portfolio perspective, and if the earning growth is happening, decent part of that earning growth should convert into the stock return over a period of time.
Thanks, Sandeep, for the concluding remarks. It was a very comprehensive coverage on the domestic resurgence portfolio. Ladies and gentlemen, we conclude the webinar with this for today. We look forward for your active participation in these webinars on an ongoing basis. Please note that the recording for the session would be available shortly, and it's posted on our YouTube channel. You can revisit the same at your own convenience. So with that, I will end the session today, and thank you all once again for the participation today in the webinar for the domestic research portfolio. Good day and good weekend ahead.
Thank you, everyone. Have a good day.